Hello everyone, this is the last learning objective of week 1. There are many ways that you can execute an investment philosophy. So in this learning objective, we are looking at the ways you can invest money that you actually don't have. You can invest money more than your current wealth. So we are looking at margin investing and short selling. So margin investing is basically the process by which you borrow on a margin account. That means a loan top account that allows you for borrowing to purchase asset. So margin purchase, for example, borrowing money to invest in shares in a market. How this work? So what you do is you borrow money to invest. Obviously, you will have to repay the loan eventually, plus the interest, fees and charges as well. So when it comes to margin investing, the broker is obviously putting themselves at some degree of risk. So what the risk is you might not be able to repay the loan. So what the broker will seek to protect themselves in different ways by which the broker will try to align the investor's interest to their interest. So what that means is the broker will often say, well, we will lend you X amount of dollars to invest as long as you put up a certain amount of your own. So the percentage an investor's own fund or the investor's own capital they need to put up is known as initial margin. Brokers will stipulate a particular percentage of overall amount that investor must put up at any point in time. That call is actual margin. So actual margin at any point in time is the ratio or the percentage of investors' own capital divided by the market value of asset. So if you look at the ratio here, the actual margin is market value of assets minus loan divided by market value of assets. So if you look at this example, let's say that an investor initially pays $6,000 toward the purchase of $1,000 worth of stock, 100 shares at $100 each, borrowing the remaining $4,000 from a broker. So initially the balance sheet looks like this. The value of a stock is $10,000 and equity, the investor's own capital is $6,000 and loan from the broker is $4,000. So the margin is 60%. That's the equity divided by value of a stock. Now, as we were talking about that investors will be required to put a margin. So how that's gonna help the margin lender from protecting from the risk. So what the lender will do, margin account will be marked to market every day. Basically what that means is market price of the equity portfolio that change every day. The managers will calculate that on a daily basis, and what broker will do, they will stipulate that if margin falls between a stipulated value, the value is known as maintenance margin, then a margin call will be made and investors are required to top up that account with their own funds. Again, in order to protect the brokers from their excessive risk. So if you look back the example, you can see that initial margin was 60%, but when the value of a stock falls below from $100 to $70, now the value of a stock is $7,000. The loan from the broker is $4,000. The equity reduced down to $3,000. Now the margin is 43%. So you can see that initially it was 60%, but now it declines to 43%. So what broker actually is going to do, broker will stipulate a minimum percentage that the investor must maintain. And if the margin falls below that, the investor will be asked to put up more funds in their account. So if you look at this example, suppose that maintenance margin is 30%. Now, how far could the stock price fall before investor get a margin call? Let P be the price. So the investors 100 shares, so it's 100p. The equity is 100p minus $4,000. You can remember $4,000 was the borrowed fund. So percentage margin is 100p minus 4,000 divided by 100p. So if you solve for p, it is 30%. It means that if your price falls in such a level that your margin falls below to 30%, then you will receive a margin call. And that is 57.14. So if the price falls below 57.14, the investor will receive a margin call. Now the next question is why investors trade on margin. So look at this example. In this example, we will see that margin investing magnifies our return. So let's purchase of security, purchase price of the security is $50. The price of the security is now $65. If you buy 100 units, you can see 6,500 is the current price, and your purchase price was 5,000. So if you divide by 5,000, that's your investment. So your cash return is 30%. Now, you can remember that your investment was 5,000. Now, as your total cost is 5,000, let's say your initial margin is 60%. That means your capital is equity capital is 60%, remaining is borrowed fund, and interest rate is 11%. So now if you calculate your return, 65, that's the current price, 50 was the purchase price multiplied by 100 number of shares. This is the amount of loan and multiplied by the interest rate, so that's the interest cost, divided by your equity capital. So its margin is now, margin return is now 42.7%. So previously return was 30%, now the return is 42.7%. So you can see for margin investing, your return increases from 30% to 42.7%. However, you should remember that that's the one side of the coin. The other side of the coin is margin investment not only magnifies your return, it also increases your risk, because if stock price declines, your return will be negatively impacted. For example, you can remember that your purchase price was $50. Previously, we considered current price is $65. Now let's say that current price declined to $40. So in that case, now your cash return will be 20%. Why? Your investment was 5,000, but the current value of your investment is 4,000, so your cash return is 20%. Now, what if you have invested using margin? If you look at this, you will see that margin return is 40.7%, so negative. So your cash return will be negative 20%, but your margin return will be negative 40.7%. So you can see that when investors anticipate that stock price will go up, they can invest using margin to magnify their return, but that increases their risk as well. The next, we are going to discuss short selling. Normally, an investor would first buy a stock and then sell it. The idea of short sell is this is reversed. That means first you sell, then you buy the share. In both cases, you begin and end with no shares. So a short sell allows an investor to profit from a decline in a security's price. So what does it mean? An investor borrows a share of a stock from a broker, sells it. Later, the short seller purchases the share of the same stock at a lower price and replace it. Okay, so this is how they make a profit. So short seller anticipates that stock price will fall, so the share can be purchased later at a lower price than it initially sold for. Okay, so short seller reaps a profit. Short seller must not only replace the shares, but also pay the lender of the security any dividends paid during the short sale. Okay, so in practice, the shares loaned out for a short seller are typically provided by the short seller brokerage firm, which holds a wide variety of securities of its other investors. So if you look at this example, in a normal purchase of a stock, what we do is we purchase a stock, so we pay our initial price and we later sell, so we get our ending price and dividend. However, with a short sale, what we do is, first of all, we sell. Okay, we sell, so we get the initial price, but after a later period we need to buy and replace, so we pay the ending price and dividend. Now, with the short sale, the exchange requires that the short seller keep the proceeds from the short sale with the account. That means the short seller cannot invest this fund or cannot withdraw this fund unless the short sale position is settled down. Okay, and also the short seller is required to post margin to be able to cover losses. What that means is, short seller short sell with an anticipation that share price will decline, so they will be able to buy the share at a lower price to replace it. But what if the share price goes up? So the short seller will end up losses. That's why short seller requires to put margin to be able to cover these losses. If you look at this example, it's a dot bomb stock. Its market price is 100 per share. You tell your broker to sell short 1,000 shares. The broker borrows 1,000 shares. So these 1,000 shares are borrowed and sold. So what happens is there is a cash proceeds of 100,000. Okay. Suppose that a broker requests you to put 50% margin. That means you must have cash or other securities in your account worth of $50,000. Okay, so let's say you have $50,000 in treasury bills. So what happens, you can see, is that you have $50,000 of your equity and your short sell position is $100,000 because 1,000 shares were sold. But by selling these 1,000 shares, you have 100,000 of cash and $50,000 of treasury bill. So your initial margin is 50%. Now, what happens is, if let's say that your price of the share was $100, now the share price falls to $70, you can now close your position. So what you do is you buy 1,000 shares at $70, so your purchase price is only $70,000, and so your account was credited $100,000. That means you make a profit of $30,000. However, short selling has some costs. For example, you need to pay transaction costs, you have to have initial margin, and also you have to pay fees. And as I mentioned earlier, that any interest or dividends accrued, you also have to pay. And losses are theoretically indefinite, because if the share price goes up, you have to bear losses. So in summary, in week 1, we learned about investment philosophy, different components of transaction costs, and also margin trading and short selling. Thank you very much.